Hey there! Welcome back to our YouTube channel. If you're new here, we focus on all things personal finance and investing, sharing practical tips and insights to help you make smart financial decisions. In today's video, we're going to discuss a topic that's especially important for anyone starting their investing journey: the common mistakes beginners make and how to avoid them. Investing can be a powerful tool to grow your wealth and secure your financial future, but it can also be daunting when you're just starting out. It's easy to fall into certain traps or make decisions based on misconceptions, which can hinder your progress and even result in losses. To help you navigate the world of investing with confidence and avoid these pitfalls, we've compiled a list of top mistakes that beginners often make, along with actionable tips on how to steer clear of them. So, if you're ready to start investing or you're looking to refine your strategy, grab a notepad and pen, and let's dive into these common mistakes, and most importantly, learn how to avoid them for a successful investing journey. Stay tuned, and don't forget to like, subscribe, and hit that notification bell to stay updated on our latest videos. Let's get started. 1. Failing to have a clear investment plan. One of the most common mistakes beginners make is not having a well-defined investment plan. Such a plan should outline your financial goals, risk tolerance, time horizon, and preferred investment vehicles. Set clear financial objectives and create a roadmap to achieve them. Assess your risk tolerance and tailor your investments accordingly. Revisit your plan regularly and adjust it as your circumstances change. 2. Not diversifying your portfolio. Many beginners invest too heavily in a single stock or sector, which can lead to unnecessary risks and potential losses. Diversify your investments across different asset classes like stocks, bonds, real estate, etc., and also different industries. This helps spread your risk and reduces the impact of poor-performing investments on your overall portfolio. 3. Investing in what you don't understand. Novice investors sometimes buy stocks or other investment vehicles without fully understanding how they work, the risks involved, or the company's financial health. Before investing in any asset, thoroughly research the company or financial product. Understand its business model, financial statements, and the industry in which it operates. Only invest in opportunities you genuinely understand and believe in. 4. Trying to time the market. Many beginners attempt to time the market, buying low and selling high, which is nearly impossible to do consistently. Focus on a long-term, buy-and-hold strategy. Instead of trying to predict market movements, invest in high-quality assets and hold them for an extended period. Dollar-cost averaging, where you consistently invest a fixed amount over time, can help reduce the impact of market fluctuations. 5. Succumbing to fear and greed. Emotions can wreak havoc on your investment decisions, causing you to sell out of fear during market downturns or chase performance due to greed. Develop a disciplined investment approach that focuses on your long-term goals. Stick to your plan and avoid making impulsive decisions based on emotions or short-term market fluctuations. 6. Ignoring fees and expenses. Beginners often overlook the impact of fees and expenses on their investment returns. High fees can significantly erode your gains over time. Always research the fees and expenses associated with an investment, such as brokerage fees, management fees, and taxes. Opt for low-cost investment options, like index funds or ETFs, whenever possible. 7. Neglecting tax implications. Many new investors fail to consider the tax implications of their investment decisions, which can result in an unwelcome surprise come tax season. Understand the tax consequences of different investments, such as capital gains, dividends, and interest income. Consult with a tax professional or financial advisor to help you make tax-efficient investment choices. 8. Focusing on short-term gains. New investors often obsess over short-term gains, which can lead to frequent trading and a disregard for long-term growth. Adopt a long-term investment mindset. Focus on the potential for sustainable growth and compounding returns, rather than getting caught up in short-term market fluctuations. 9. Relying on tips and rumors. It's not uncommon for beginners to base their investment decisions on tips or rumors from friends, family, or social media. Always conduct your due diligence and research before making an investment decision. Be skeptical of hot tips and rumors, as they may not be reliable or based on accurate information. 10. Failing to monitor your investments. Some novice investors make the mistake of ignoring their investments after the initial purchase, which can lead to missed opportunities or losses. Regularly review your investment portfolio, assessing its performance and rebalancing it as needed to maintain your desired level of diversification and risk tolerance. Stay informed about market news and developments that may impact your investments. 11. Overconfidence and overtrading. Overconfidence can lead beginners to believe they have superior knowledge or skills, which can result in excessive trading and poor decision-making. Stay humble and recognize that investing involves risks and uncertainties. Focus on building a solid investment plan and avoid making impulsive decisions based on overconfidence. 12. Not taking advantage of tax-advantaged accounts. Many beginners miss out on the benefits of tax-advantaged accounts, such as IRAs, 401ks, and Roth IRAs. Maximize contributions to tax-advantaged accounts to enjoy tax-deferred or tax-free growth, depending on the account type. These accounts can significantly enhance your long-term investment returns. 13. Borrowing to invest. Using leverage or borrowing money to invest can be tempting for beginners but can result in significant losses if the investment doesn't perform well. Avoid using leverage to invest, especially as a beginner. Instead, focus on building your wealth through consistent, disciplined investing with your own money. 14. Not seeking professional advice. Some new investors may be hesitant to seek professional advice, thinking they can handle everything on their own or not wanting to pay for advice. Consider consulting with a financial advisor or planner, especially when you're just starting. A professional can help you create a tailored investment plan, identify suitable investment opportunities, and provide guidance on avoiding common mistakes. By understanding and avoiding these common investing mistakes, you can set yourself up for long-term success and grow your wealth more effectively. Remember that investing is a journey, and learning from your mistakes is a critical part of the process. Stay disciplined, focused on your goals, and open to learning new strategies and tactics. We hope this video has provided you with valuable insights into the investing mistakes beginners should avoid. If you found this information helpful, please like, share, and subscribe to our channel for more educational content. And as always, feel free to leave any questions or comments below.